It was probably about year 2 or 3 of running the fund that I kind of had a aha moment. My first aha moment was roll up your sleeves, get on planes, and go visit companies that no one else is visiting. Um, and you might only find 2 or 3 investable companies a year, but those 2 or 3 are worth all the plane rides because that plane ride home is so exciting when you're like, I just discovered a wonderful business that's trading at 50 cents on the dollar and no one else knows about it. I think the first one that I can really remember flying home from Dallas Fort Worth after meeting with Dayton Judd of FitLife, just being like, I just found an undiscovered gem, and that's really what I live for, is finding companies like that. Um, so it was probably about year 2 or 3 into running the fund that I realized that just because micro cap and the smaller end of small cap companies are mispriced. We bought Fit Life at 5 times earnings. I think we bought ownership of Fit Life at 5 times earnings, somewhere around there, and that's just Dayton Judd is the A plus CEO. But just because they're undervalued doesn't mean that a light switch is just going to come on one day and it's going to become fairly valued. So I realized it's my job to my investors to make sure we can do whatever is in our control or in my control of making sure this company becomes fairly valued. So there's a few different ways I think about it. I think if they want to buy back the first thing I do is convince them to buy back as many shares as possible. So first, let's capitalize on the fact that it is undervalued. We don't need to send the share price up to fair value immediately. Let's buy back as much stock as we can while it's discounted. You'll see a lot of management teams in microcap companies get very frustrated at the undervaluation of their company. They're like, I'm doing everything right. I'm running the company correctly. I'm doing presentations every quarter. I'm going to conferences, but we're still trading at 50 cents on the dollar. So my message early on was really, instead of getting upset about that, let's take advantage of how mispriced this company is. So that was almost always buying back shares, and then is that slowly? I would always go and visit. I felt that the message was much better delivered if I visited the management team in person, and I still do that. And we'll go with a 2 or 3 page slide. To give you an example, there was a company that was considering acquiring another company, and they were going to pay 10 to 15 times earnings. And I said, instead of acquiring another company, why don't you acquire more of your own company at 5 times earnings? And I think, just a simple explanation like that often clicks. Because what you'll find with a lot of these micro cap and small cap management teams is they have so much weight on their shoulders. They have a very small team around them. So they're so just heavily focused on the operations and running the day-to-day operations of the business that they're not really thinking much about shareholder return. And that's not for all the companies we own. Some of the companies we own, when I fly to visit them once a year or when I talk to them once a quarter, I just say, thank you for what you're doing. Keep doing everything you're doing. It's working great. So that was the first step of becoming what I call a suggestivist investor. The next step was recommending for some companies, I don't think it's for all companies, but for some companies to uplist onto the NASDAQ if they're traded over the counter. I think you got to weigh the pros and cons of doing that. It obviously costs more to uplist, but I think a good example is go back and look at the chart of FitLife before they uplisted and after they uplisted. And the pros and cons you have to weigh is for FitLife, there was multiple investment firms that wanted to invest in FitLife. They had done all the research. They were staring at the company. They wanted to own the company so bad, but it was over the counter, and the investment firm had a mandate that they could only buy NASDAQ or NYSE traded companies. So you can watch it. The second that FitLife went from over the counter to Nasdaq, the share price immediately went up, and I think it's almost up 80 to 100% since they've done that. I might be slightly off of the numbers there, but it's quite a bit. So for a company like that, it makes a lot of sense because maybe you're paying $1 million more in fees, maybe $1.5 million. That number is highly debated, but let's just throw that number out. That makes a lot of sense. Whereas Truxton Trust, a company we own, they have a tight shareholder base. They generate a tremendous amount of free cash flow. It's just a beautifully run company, and they don't ever really need to raise any equity. And I've gone back and forth with them about whether it makes sense to uplist, and they feel that paying the lower fees is the right thing to do. They feel like saving $1 million or $2 million per year is actually the appropriate thing to do. So I've seen it, both sides of it make sense. And actually, I just had a company we own, old market capital delist from Nasdaq to the OTC. Most of the time, when you see that, there's heavy insider ownership and a tight shareholder base. So they're really just purely focused on free cash flow and just maximizing free cash flow. And not that FitLife wasn't, but FitLife was just constantly getting outreach from institutional investors, and they knew that there was huge demand for their stock if they were to uplist. And then kind of the third phase has been talking more and more with management teams about divesting non-core assets, getting rid of selling businesses that really are not within their core competency. I think the reason a lot of this has become more and more successful, and not every company I talk to listens to my feedback and implements it. But it's been a lot higher percentage than I ever expected. I think a lot of this has come from the long-term mindset of our fund. A lot of the companies we owned, we bought 5 or 6 years ago. So I've visited with these management teams 5, 6, 7 times in person. I've talked to them 20 to 25 times in person, and have developed a really nice relationship with them. So they know that the suggestions that I'm giving are not suggestions that are meant to boost the share price really quickly so I can sell. It's because I think this is what's the best for the company and the shareholders of the company over the next 5, 10, 15 years. And then, so to go to your last point, is kind of where I'm looking at 2026, 2027, is despite all that work, and I'm still pitching every company to buy back shares and do all the things I just mentioned. I still think almost every company we own is undervalued. So I think what that means is I need to roll up my sleeves even more and get more actively involved in the companies we own. And I think that's going to involve, I want to be on a few boards this year and next year, and whether that's myself being on the board or finding someone to represent River Oaks Capital that they would provide more value on the board than I would. I think something that I think is really interesting, and you can see it from a company we own called Ascent Industries. What they do in their presentation is they clearly position themselves. They say, here's our earnings before public company costs, and here's our earnings after public company costs. So what they're showing in all their presentations is, here's our value to a strategic or to a private equity firm. And I think that's really what every company should start doing in the microcap space is you don't have to sell the company this year. You don't have to sell the company in 5 years. You don't even have to sell the company in 10 years, but at least put the option on the table of selling the company and letting it be known that when the time is right, we are open to selling the company if the price is appropriate, and positioning yourself to strategics and private equity firms to show the value within the company that would be created if you sold to them. I think it makes a lot of sense. I don't see the downside in doing it. You obviously have to align with the proper companies because you need a lot of insider ownership. You need the CEO to own quite a bit of stock because let's say his or her salary is 400, $500,000 a year or somewhere around there, but they own 0% of the stock. They would have no interest in selling the company. They would much rather just collect their salary. So you have to make sure that you're positioning yourself with um, the right type of company, and that's all. That's a checklist that has to be checked off, anyways. For me, there has to be high insider ownership. But I think that's really an area, and I'm not saying I'm going on the board to pitch that, but I just think it's you need share buybacks as an option. You need potentially uplisting the option. And I think you need potentially selling the company or selling a piece of the company or selling to a strategic or private equity as an option. It doesn't have to be an option now. If you feel like if you feel like the earnings of the company are going to be way higher in 3 years, then by all means wait for 3 years or wait for 5 years. But I don't see any downside that I can think of at least making that one of the options for getting to fair value.